Hello, everyone, and welcome to this week's episode of the Weekly Tanker Market Podcast. I'm Trisha, your host, and today we'll be exploring the key trends shaping the tanker market for the second week of 2025. I'm thrilled to have Sandesh with us, our go-to expert on crude, CPP, and LPG markets. So, welcome to the podcast, Sandesh.
Hi Trisha, as always, thank you so much for having me here today, and we have something very specific to discuss.
So, Sandesh, the second week of 2025 was a busy one for the tanker market, especially in the ex-MEG region. We saw some promising demand for end January loading. Could you tell us more about how the market is performing?
Definitely, Trisha, there is a lot of happening right now. Let's start with the XMEG, and that is Middle East Gulf. The VLCC push for end January loadings. So, it brought more demand and it helped tighten tonnage. And this could push up rates in a future week, especially with the China involved. However, the inquiries for the second decade of January, those are kind of limited, and with some owners they are pushing for higher rates while others accepted current levels due to lack of significant demand boost, specifically from China and Korea. So in the midweek, we have seen the market with a minor increase and in terms of activity and freights. And it is specifically because the participants, those are the traders and cargo owners, they returned after the holidays, and though the effect of the US Department's defense actions on Chinese companies was minimal, it keeps rates range bound. So as the week progressed, the sluggish trading continued with charterers and owners aligning on market levels. So although a few fixtures were slightly above previous levels, rates kind of remained stable. And towards the end of the week, activity picked up the stronger demand, and end January loadings, we saw the market remain cautious. So towards the week's end, activity picked up with the stronger demand for end January loadings, though the market remained cautious. Now let's move to XWAF, that is West Africa. So cargo activities are picking up as well with similar like MEG area. So the activity they grew throughout the week, and by the week's end, we saw a real shift in momentum with cargoes coming in and fewer ships available. And at the same time, there is a kind of a limited competition amongst vessel owners, and it lead to higher freight rates. Even though VLCCs are still more affordable options, charterers, they try to secure tonnage quickly before the east of the Suez. It gets even tighter, and that could affect global availability of VLCCs. Now, as for ex-USD market is concerned, the market ended the week on a positive note in terms of freight rates. So rates, they were initially dropped in the midweek, but as the week progressed and by the week's end, they surged back to about $6 million for lump sum basis for eastbound routes, specifically for the China and Korea bound voyages. And you know what? This shows that the market is improving and demand is picking up. So when you put it all together, regional trends and tightening tonnage, it's clear that we could see some shift in the market, and these changes might make shipping more expensive globally as tonnage becomes harder to come by. So for tanker owners, this could be a great chance to take advantage of rising rates. And for charterers, it's a race to secure vessel before prices go up even more. Overall, it's an exciting time, and in the next few weeks, we are going to be key to how this all plays out.
Great insights, Sandesh. Like you said, with everything happening, especially the regional trends, things are definitely heating up. So I guess it will be interesting to see how this all impacts the market in the coming weeks. Now, shifting gears a bit, let's talk about the Suezmax and the Aframax segment. Can you walk us through what happened in those segments and what the market might be expecting next?
So for Suezmax, things have been kind of a bit up and down. And in XMEJ, that is Middle East Gulf, there is a little boost in freight rates early on in the week, and it was nice. But then the market pretty much leveled out and stayed quiet. There are a few private fixtures, but overall there isn't much happening. The lack of new cargoes and then the pressure from VLCCs, it kept the rate from moving much. So over in XWAF, we saw some recovery later in the week, but rates are still pretty low. Charters are definitely taking advantage of this particular situation. But yeah, we are kind of waiting for some external event to push things in a clearer direction. So as for Aframax, the ex-MEG, that is Middle East Gulf, it's still a pretty quiet, and there is a lot of tonnage available. So, we are kind of having excess tonnage for Aframax in the Middle East Gulf. And you know what this suggests is it is putting some of downward pressure on freight rates even this week, and even in coming week, the pressure will be there unless and until most of the tonnage will be clearing out. And as for the owners, they are just not ready to commit yet. So it is a situation in the Middle East Gulf. In ex-SCA, that is Southeast Asia, things aren't looking much better. So kind of a similar situation in both the region. Here in SCA, rates are still dropping. For instance, if I have to say TD14, it fell from 116.13 to 111.56 for world scale basis, and that drop is within a week. So charterers, they are really holding strong, and they are pushing for lower rates. But they are able to do that since older vessels are available. So overall, the Aframax sentiments, they are weak right now. So unless we get a big jump in demand, I think the pressure is going to stick around for a while.
That said, I guess it's more of a wait and see game right now. With all that extra tonnage and those low rates, even charters would be taking advantage of the situation. But yeah, I guess we'll have to wait and see if anything major shakes up the market anytime soon. Well, now shifting our focus on the CPP market, we saw LR rates really pick up, especially on the AG Japan routes, and even the LR2s are doing great. Although the same can't be said for MRs, but do you think the LR segment can keep this up, or do you think it'll slow down a bit as we head into February?
Yeah, Trisha, it's definitely been an exciting week in the LR segment. We have seen LR2 rates, they have surged pretty impressive, specifically with tonnage tightening and the strong demand coming from AG Japan market. We have seen a 13% rise in rates month on month. And you know what? It is not a small thing. I think there is a good chance the momentum could stick around for a while, at least for the LR2s. The big question is whether the seasonal demand for gas oil will hold steady, or if we will start seeing a slowdown as we get into the February. So if tonnage it keeps tightening like this, it should definitely help keep rates up for LR2s. But on the flip side, MRs might be in for a kind of a bit of a tougher ride, specifically in the Atlantic market. So we have seen rates start to dip there, and it could make harder for them to gain some traction. So it's really going to depend on how that balance of supply and demand plays out in the coming weeks. So if we keep seeing strong cargo flows and tight tonnage, that could keep the market in a good place. But if the demand starts to soften, we might see things slow down a bit.
You're absolutely right, Sandesh. I guess it really depends on how that balance of supply and demand plays out. If demand stays strong, we could see continued momentum, especially for the LR2s. But if things slow down a bit, especially for the MRs, the market might start to cool off somehow. So I guess it's definitely something to keep an eye as we head into February. Now, lastly, let's have a look at the LPG sector, for which I'd like to welcome Shruti, our expert in the LPG segment. So, Shruti, there seems to be some subdued freight activity in the east and the west of Suez. So, could you tell us more about what's happening over there?
Right, Trisha, thanks for having me. So, you see, over in the east, there's not much action coming out of the Arabian Gulf. And with that, long position list in the Middle East Gulf is just adding to the sluggishness. And most of January cargoes are already covered. So, things are a bit quieter compared to the last few months. But here's the thing, as vessels ballast west, rates might dip for January. But that could firm up as we get closer to February when availability tightens up. Now, to talk about the West, things are kind of similar. So, the market's been pretty quiet, mostly because of that fluctuating arbitrage window and the cold snap in Houston. So, charterers just aren't jumping to fixing cargoes right now. But we did see rates dip a bit midweek. But by Friday, owners seemed to get more hopeful as relets were either absorbed or pushed to February. So, the big players like BW and Helios are dominating the US Gulf, and that oversupply might keep rates from going up too much for the next week. But still, with fewer relets available, we could see the market stabilize or even rise come February. It's all about how vessels are positioned, really. So that will determine the direction of rates in the next few weeks.
You're absolutely right, Shruti. Although both the markets are quiet now, but with changing positions and tighter availability, there's a good chance things might heat up closer to February. So I guess we'll have to wait and see how that works out. So with that, I'd like to thank both of our speakers, Sandesh and Shruti. Thank you so much for joining us. It was truly an insightful and an engaging discussion with the two of you. So with that, we wrap up today's episode. To everyone listening, we hope you find it insightful as well. Thank you so much for tuning in, and do not forget to share and follow us. Until next time, navigate safely and stay informed.